Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So, usually when we picture global finance, we imagine it as this perfectly balanced ecosystem, like a massive cargo ship just slowly turning in the ocean.
Right. Very slow, very predictable.
Exactly. But then you look at what just happened over in Tokyo, and suddenly that cargo ship has thrown it in reverse. The alarms are blaring, and the captain is literally throwing billions of dollars overboard to keep the whole thing from sinking.
Yeah, it is the absolute definition of a financial shock and awe campaign. I mean, what we are looking at in the recent data is a truly massive historic event in the global currency markets.
It really is. And the mission of our deep dive today is to unpack exactly what happened, how it happened, and why it actually matters to you. Because the numbers here are just staggering.
Oh, absolutely staggering.
Right. I mean, according to the data, Japanese authorities effectively dropped around $35 billion in a single day just to protect their currency, the yen, from absolutely crashing against the U.S. dollar.
Yeah, 35 billion with a B. It's wild.
It's totally wild. Now, if you are sitting here in the United States, maybe you're just a beginner in economics or you're trying to get a handle on your first investment portfolio, you might be wondering, why should I care about what the yen is doing thousands of miles away in Tokyo?
Which is a totally fair question. But the reality is that global currencies are deeply, inextricably linked. I mean, what happens to the Japanese yen affects the US dollar, it affects global inflation, and it absolutely affects anyone holding international investments.
Right, you can't just look at the U.S. economy in vacuum.
Exactly. You really can't. To understand why Japan just dropped $35 billion, we actually have to start by setting the stage with what is happening right here at home.
Okay, let's do that. And just a quick note for you listening. Our goal today is to break down the economic data from our sources completely impartially. We're not endorsing any political viewpoints. We are just looking at the math. So looking at that data, what is the U.S. landscape doing to foreign currencies right now?
Well, if we look at the current landscape under President Trump's administration, the U.S. economy is operating with very high interest rates. And when U.S. interest rates are high, the U.S. dollar becomes incredibly strong.
So it's basically flexing its muscles on the global stage.
Pretty much. It acts almost like a giant gravitational pull. It draws global capital toward the United States because, investors know they can get a great, safe return on their money here.
Right, that makes sense.
But that strong dollar creates this intense crushing pressure on foreign currencies. And right now, Japan is feeling the absolute brunt of that pressure.
Okay, so the U.S. dollar is essentially bullying other currencies because our interest rates are so high. Let's look at how that pressure reached an absolute boiling point in late April and early May.
Yeah, it was a really dramatic couple of weeks.
Because the yen wasn't just slipping, right? Market observers noted it was in a total freefall. It approached this critical flashing red level of 160 yen to 1 U.S. dollar.
Which is a huge psychological barrier.
Exactly. And then suddenly, it violently reversed course.
Yeah.
The data shows that on April 30th, the U.S. dollar dropped by up to 3% against the yen in a single day.
Yeah.
The liquidity reports show that was the biggest daily drop since late December of 2024.
It was a massive swing, and it's crucial to understand that it did not happen organically. The market didn't just, wake up and change its mind.
Right, it's artificial.
Completely. Analysis of Bank of Japan data estimates that Japanese authorities spent up to 5.48 trillion yen, which is about 35 billion US dollars, to artificially prop up their currency.
Wow.
They stepped directly into the open market, took their massive reserves of US dollars, sold them, and bought their own currency to force the value back up.
$35 billion.
Yeah.
I really want to ground that number for a second because it's so easy to just get numb to the word billion.
Oh, for sure. It just sounds like monopoly money after a while.
It does. But to put that in perspective, they essentially spent the equivalent of the entire GDP of a small country in a matter of hours just to move the needle on a single currency fractionally. That is wild.
It really is unprecedented on that sort of timescale.
And when I was going through the research, the number that really stuck out to me was that 160 mark, 160 yen to the dollar. It reminds me of the red overheating gauge on a car's dashboard.
Oh, that's a great way to put it.
Because 160 isn't a legal rule, right?
Yeah.
There is no international law saying the yen can't go to 161 or 170, but it's this invisible psychological line in the sand. Once that needle hits the red zone, the engine is in danger of blowing up.
That is a perfect analogy. And what's fascinating here is why 160 is that red line. I mean, it's not just about national pride or politicians wanting a strong-sounding currency.
Right, it's practical.
Highly practical. It is fundamentally about the everyday cost of living for the Japanese people. You have to remember, Japan is an island nation with very few natural resources.
So they have to import basically everything.
Exactly. They have to import almost everything from the food they eat to the energy they use to power their cities.
Right, and they have to buy all of that on the global market, where goods are almost exclusively priced in U.S. dollars.
Bingo. So let's trace how that actually impacts a regular person in Tokyo. A weak yen means that buying those imported goods suddenly costs significantly more.
Right, because their money doesn't go as far.
Right. If it takes 160 yen to buy a single dollar, the price of imported wheat for bread or imported natural gas to keep the lights on, it just skyrockets for the everyday consumer.
Oh, wow. So it's basically instant inflation at the grocery store.
Exactly. So the intervention dropping that $35 billion was a very clear, very expensive message to the global market. They were saying Japan will not let that 160 line go undefended.
Because the imported inflation becomes totally intolerable for their citizens at that point.
Right, economically and politically.
Okay, so they step in and buy their own currency to make it stronger. But this brings up a very logical question that I think, any American beginner would ask right now.
Let's hear it.
Wait a minute. Here in the U.S., when we face economic shifts or inflation, our central bank, the Federal Reserve, just adjusts interest rates. If Japan wants its currency to be stronger, why go through this crazy $35 billion market intervention? Why doesn't Japan just raise its interest rates?
Yeah, that is the ultimate question here. Why not just raise rates? It seems like economics 101.
Right, just hike the rates.
But to understand why they don't, we have to look under the hood of the Japanese economy. They are trapped in a very painful dilemma. Our sources describe Japan's current situation as a triple whammy.
A triple whammy. Okay, break that down for me.
Basically, they are being hit simultaneously on three fronts: a weak currency, rising bond yields, and surging oil prices.
Let's focus on that oil piece for a second. Because the data shows oil prices have surged past $110 a barrel, heavily aggravated by the conflict involving Iran and, broader tensions in the Middle East.
Yes, that's a huge factor right now.
And like you just mentioned, Japan imports almost all of its energy.
Right. So combine part one and part two of that whammy. You have a historically weak currency plus incredibly expensive oil that equals massive imported inflation.
Right, because they are paying top dollar for oil with a currency that's at rock bottom.
Exactly. It costs them an absolute fortune just to power their industrial base and heat their homes.
Okay, so again, if inflation is spiking because of expensive oil and a weak yen, why not hike the interest rates to strengthen the yen and make the oil cheaper to buy? I mean, we did it here in the U.S.
Because the underlying Japanese economy is far too fragile to handle it. That is the third part of the whammy.
Oh, interesting.
You have to remember, Japan has spent decades fighting deflation, which is falling prices, and they have an aging, shrinking population. Their economic engine does not run hot like the U.S. engine does.
So they can't just slam on the brakes.
Exactly. The Bank of Japan cannot simply hike rates aggressively. Raising interest rates makes borrowing money more expensive. It slows down business growth. It slows down consumer spending.
Right, people stop taking out loans.
Yeah, and it makes variable rate mortgages more expensive for regular homeowners.
Oh, wow. So if the Bank of Japan raises rates to save the yen, they risk completely crushing their own domestic economy.
Yes. They could trigger a severe recession, bankrupt businesses, and cause a wave of housing defaults.
Man, that is a brutal choice.
It really is. They are effectively trapped between burning the house down with imported inflation or freezing to death in a self-inflicted recession.
Jeez. So that's why they did the intervention.
Right. Intervening directly in the currency market, literally spending $35 billion to buy yen, is a way to just buy time.
It's a temporary Band-Aid.
A highly expensive Band-Aid, yeah. It stops the bleeding without choking the domestic economy with high interest rates. They are trying to hold the 160 line while crossing their fingers and hoping that global conditions eventually cool down on their own.
Like hoping the price of oil drops or U.S. interest rates go down.
Exactly.
Okay, so they spent $35 billion to buy time. But I was looking at the dates in the research, late April, early May. Wait a second, isn't that right in the middle of Golden Week in Japan?
Oh, you caught that. Yes, it is.
Yeah, and for those who might not know, Golden Week is a major string of national holidays over there. The markets are basically closed. Most of the country's on vacation. Why would a central bank execute a massive historic market intervention when nobody's working?
Because that is the brilliance of the move.
Mm.
The timing wasn't a coincidence, it was a tactical strike. You have to understand the concept of thin liquidity.
Okay, let's define that for the listener. Thin liquidity.
Sure. So in financial markets, liquidity refers to how easily you can buy or sell something without affecting its price. On a normal Tuesday, when liquidity is high, there are millions of buyers and sellers constantly trading.
Right, lots of action.
Right. And if someone drops a large order, it gets absorbed easily by the sheer volume of the market. But during a holiday like Golden Week, most of the institutional traders are at home. The volume drops off a cliff. The market is empty.
Okay, I love visualizing this. Imagine you are at a massive, crowded public pool on the 4th of July.
Okay, I'm picturing it.
If you jump off the diving board and do a huge cannonball, you'll make a splash, sure.
Yeah.
But the ripples are instantly absorbed by all the other people and the sheer size of the moving water. That's a normal trading day.
Right.
But thin liquidity during Golden Week.
Right.
That is like doing a cannonball into a tiny backyard hot tub.
Right.
There's barely any water, there's nobody else in there to absorb the impact, and your cannonball is going to violently blast water everywhere.
That is incredibly accurate. I love that analogy. Because the market was practically empty, Japan's intervention acted exactly like that hot tub cannonball.
So it made a way bigger splash.
Much bigger. Market analysts refer to it as a small, calibrated operation that created a massively amplified price reaction precisely because of that thin liquidity.
Wow.
They didn't have to spend $100 billion to move the needle. $35 billion in an empty market was enough to cause absolute chaos.
Wait, hold on, though. I have to push back on this a little bit.
Sure, go ahead.
If I went into my personal brokerage account and tried to violently move the price of a thinly traded stock just to trigger a price spike, I'd get investigated by the SEC for market manipulation. How is it brilliant when a central bank does it? Aren't they essentially rigging the game?
Well, it's a fantastic point, and it really highlights the unique privilege and power of central banks. They operate on a completely different set of rules because their mandate is national economic stability, not personal profit.
I guess that makes sense.
But to your point, they were absolutely trying to punish specific players in the market. That was the secondary goal of this Golden Week timing. It acted as a loud, brutal warning shot to short sellers.
Okay, let's clarify short sellers for the listener. These are investors who are literally placing bets that the yen will keep dropping. They borrow yen, sell it, and hope to buy it back later at a cheaper price to pocket the difference.
Correct. And when the Bank of Japan suddenly stepped in during a low liquidity holiday and forced the price of the yen to skyrocket, those short sellers were suddenly losing massive amounts of money.
Oh, because the price went up instead of down.
Right. And because the market was empty, they couldn't easily exit their trades. They were forced to violently reverse their positions to cover their bets by buying yen at whatever price they could get.
Which actually drove the price of the yen even higher.
Exactly. They ended up doing the Bank of Japan's job for them. The central bank sent a ruthless message. Betting against the yen carries severe, sudden death risks.
Wow. Okay, so they bought time, they defended the 160 line, and they absolutely wrecked the short sellers. But let's bring in a reality check here. Did this $35 billion cannonball actually fix the underlying problem?
The short answer is no, it really didn't.
Really?
Yeah, it did not reverse the structural trend. Almost immediately after the intervention pushed the yen down to a stronger level of around 155.5 to the dollar, it slid right back down.
Oh, yeah.
Within days, it was drifting back toward the 156, 157 range.
Yeah, the data really confirms that. Major institutions like JP Morgan are still predicting that the yen could weaken even further, potentially hitting 164 by the end of the year.
Right.
It seems like the $35 billion barely bought them a week of breathing room.
And this raises a crucial point about the limits of central bank intervention. You can manipulate the market for a day, you can cause a massive splash in the hot tub, but you cannot fight global economic fundamentals forever.
It's like gravity.
Exactly. Think of the U.S. interest rates and the weak Japanese economy as gravity.
You could throw an apple in the air, but it's coming back down.
Right. As long as U.S. interest rates remain high, pulling global capital toward the dollar, and as long as Japanese interest rates stay near zero, the fundamental gravity pulling the yen down remains completely intact. The $35 billion was just a localized, temporary interruption of gravity.
Man, that's wild. So if this historic intervention couldn't fix the underlying gravity of the situation, The Bank of Japan's problem quickly becomes an American investor's problem.
Yes, it definitely does.
Let's look at how this structural failure impacts everyday portfolios, because we've talked about Tokyo and billions of dollars and central banks. But how does this connect directly back to the listener's wallet?
Good question. Let's start with international stocks, specifically Japanese companies.
Okay, let's go.
This is a crucial shift that investors need to understand. Historically, there was a very reliable rule of thumb in investing. A weak yen was great for Japanese export companies.
Like Toyota or Honda?
Exactly, massive global brands. If the yen is weak, the cars they build in Japan become much cheaper for Americans to buy in dollars. Their international sales go up, their profit margins look great on paper, and their stock prices rise.
Right, it was practically a cheat code for investors. Weak yen equals buy Japanese export stocks.
But the research indicates that playbook is fundamentally broken right now.
Why is that?
It goes back to that triple whammy we discussed. With oil sitting at $110 a barrel, the cost of importing the raw materials to build those cars and the energy to run the factories has absolutely skyrocketed.
Oh, I see.
Yeah, the benefit they get from selling cars abroad is being eaten alive by the massive costs of importing energy and materials at home.
So Japanese stocks are no longer a guaranteed win just because the currency is down.
Mm.
You really have to look under the hood of the specific company to see if their profit margins are getting crushed by imported oil costs.
Exactly. You have to be far more selective. The old correlation just doesn't hold up in an era of expensive energy and structural inflation.
That makes total sense. And then there's the other major impact for global investors, something called the carry trade.
Ah, yes, the carry trade.
I want to take a minute to really break this down because it sounds like, intimidating Wall Street jargon, but it's actually a fascinating concept that moves trillions of dollars around the world.
It really does. It's a massive force.
So I need you to walk me through this. The carry trade is basically when an investor borrows money in a country with super low interest rates, like Japan, and then takes that borrowed money and invests it in a country with high interest rates like the U.S. Is that right?
That is the core mechanism, yes. It is essentially an attempt to capture the spread or the difference between the two interest rates.
Okay, let me try an analogy to make sure I'm getting this. It's like if I took out a massive credit card that offered a 0% interest rate.
Okay, I'm following.
I take $100,000 off that credit card, and I immediately put that money into a U.S. Treasury bond that pays me 5% interest. I just get to sit back and collect a free $5,000 a year for doing absolutely nothing.
In theory, yes. That's exactly how it works. And because it feels like free money, enormous amounts of global capital flow through this carry trade.
So big institutions are doing this.
Oh, absolutely. Institutional investors, hedge funds, they borrow trillions of cheap yen, convert it to U.S. dollars, and buy U.S. Treasury bonds or American tech stocks.
Wow.
In fact, recent analysis notes that speculative bets against the yen, which are closely tied to funding this massive carry trade, are at a 2-year high right now.
But here is the catch, and this is where the risk comes in. The credit card I took out, in my analogy, isn't in dollars, it's denominated in yen.
Right, you borrowed yen.
So I eventually have to pay back the yen I borrowed.
Yeah.
If the exchange rate suddenly violently changes, like say if the Bank of Japan drops $35 billion into the market during Golden Week and the yen surges 3% in a single day, what happens to my free money trade?
It turns into an absolute nightmare for you.
Because I owe more money now.
Exactly. If the yen suddenly shoots up in value, it means you now need significantly more U.S. dollars to buy back the yen you owe. That 3% currency swing completely wipes out the 5% yield you were hoping to make over the entire year.
Oh, wow. So suddenly my free money trade is underwater.
Very underwater. And you are scrambling to sell your U.S. assets just to cover your yen debt.
That sounds terrifying for anyone using leverage. So how should an everyday investor who might just have a standard retirement account react to this?
The key takeaway is that this intervention did not end the carry trade. The interest rate gap between the U.S. and Japan is still there, so the temptation remains.
The spread is still juicy.
Right. But the Bank of Japan's intervention drastically increased the volatility and the risk of that trade. It put the entire global financial system on notice.
Meaning investors need to be incredibly careful about the ripple effects.
Precisely. In a calm market, the carry trade works beautifully. But when central banks prove they are capable of executing sudden, multi-billion-dollar market strikes that cause huge, unexpected spikes in currency values, the risk profile of international investing changes entirely.
Because if the big guys panic, It affects everyone.
Exactly. If hedge funds are forced to suddenly sell off U.S. stocks to cover their bad yen bets, that can cause sudden dips in the U.S. stock market, which absolutely affects your everyday 401k.
Okay, let's zoom out and summarize what we've unpacked today, because this is a lot of moving parts.
It definitely is.
We started with the sheer scale of the event. Japan spending an estimated $35 billion, the GDP of a small country, to defend that invisible, flashing red 160 yen line on the dashboard.
Right, the line in the sand.
And they executed this move during the thin liquidity of a national holiday to maximize the splash and brutally punish the speculators.
And we explored the why. They did it because they are trapped by a triple whammy. A weak currency, expensive $110 oil, and a domestic economy too fragile to handle the higher interest rates that would normally fix the problem.
They bought time against that strong U.S. dollar, but the structural economic gravity remains. The apple is still falling.
It is indeed.
Which leaves us with a lot to think about as global investors navigating these volatile waters, especially regarding international stocks and the hidden risks of the carry trade.
It does. And, if we look at the bigger picture, this entire event raises a truly fascinating, almost philosophical question for anyone participating in the markets today.
Oh, I like philosophical questions. What is it?
Well, we all like to think that global currency values are decided by the free market, right? That millions of buyers and sellers naturally find the right price based on economic health and corporate innovation.
Right, the invisible hand of the market.
Exactly. But if a single central bank can simply press a button, drop $35 billion into a thin holiday market, and instantly, violently alter the global exchange rate, how free is the market, really?
Wow. That is a heavy thought. It really makes you question the foundations of what we're investing in.
And the follow-up question is even more concerning. This intervention was a massive flex of financial firepower to buy time. But foreign reserves are finite. What happens to the Japanese economy and the global markets tied to it on the day they finally run out of ammunition?
Man, it really makes you wonder if that engine overheating light on the dashboard is something you can just keep resetting, or if eventually you actually have to pull the car over and face the smoke.
That's the million-dollar question, or I guess the $35 billion question.
Right. Well, it's definitely a structural shift to keep an eye on, whether you are buying international stocks, watching domestic inflation, or just trying to understand the complex machinery of how our global economy actually functions. Don't forget to subscribe and hit that like button.